If you own gold or silver right now, then you need to pay close attention because something unusual is happening across the precious metals market. Gold has pushed back toward levels that would have sounded impossible just a few years ago. Silver is moving with a different kind of energy, and the relationship between these two metals is sending a message that many investors may be missing. The most important part is that this is not just about one headline. It is about several forces moving at the same time. Interest rate expectations are shifting, the dollar is under pressure, central banks continue to add gold, geopolitical risks remain elevated, and investors are beginning to question how safe traditional financial assets really are. That combination does not happen often. When it does happen, the market can move very quickly. So today we are going beyond the headlines. We are going to look at what is actually changing in gold and silver and why this moment could become one of the most important periods for precious metals investors in years. Right now, the market is giving us a very interesting picture. Gold recently climbed toward a 2-month high before pulling back. On August 14th, spot gold was around $4,344 per ounce after falling from the recent high. Gold had gained strongly during the previous sessions as traders reduced expectations for another Federal Reserve rate hike. Silver has also been moving aggressively. Recent trading has placed silver around the mid-$60 area. That is important because silver has been showing much stronger momentum than many investors expected after its huge move earlier in the year. On August 12th, silver closed around $65.55 after gaining more than 1% that day. But here is where the story becomes much more interesting. The rare event is not simply that gold is expensive or that silver is rising. The rare event is the combination of monetary uncertainty and strong physical demand with a changing relationship between gold and silver. For years, investors could think about gold and silver as two related metals with different jobs. Gold was the monetary metal. Silver was the industrial metal. Gold was the defensive asset. Silver was the higher volatility version of the trade. That simple picture is becoming harder to maintain. Silver is increasingly being pulled by both sides of the market. It has monetary demand, it has industrial demand, it has investment demand, and it has supply limitations. That creates an unusual setup. When gold rises because investors want protection, then silver can benefit. When silver rises because industrial demand is strong, then gold can benefit from the broader precious metals momentum. When both forces appear together, the move can become much more powerful. This is why investors need to watch the relationship between the two metals instead of looking at the silver price alone. The gold-silver ratio is one of the simplest ways to understand this relationship. The ratio tells us how many ounces of silver are needed to buy 1 ounce of gold. When the ratio falls, it means silver is outperforming gold. When the ratio rises, it means gold is outperforming silver. That ratio has experienced dramatic changes during major market cycles. And that is one reason why experienced metals investors pay attention when silver begins to close the performance gap with gold. The current market is showing exactly why this matters. Gold has been supported by concerns about inflation and monetary policy. Silver has been supported by those same concerns while also receiving help from industrial demand. This creates a potential feedback loop. Investors see gold moving higher. They look at silver. They notice that silver has more volatility. They notice that silver remains far below some of its historic inflation-adjusted valuations. Then capital begins moving towards silver. That creates more momentum. More momentum attracts more investors, and suddenly the market can begin moving faster than the fundamentals alone would suggest. This is where people often make a mistake. They see a large move and assume the entire story is speculation. But markets can have speculation and structural demand at the same time. The key is understanding which force is dominant. Right now, several forces are working together. The Federal Reserve remains one of the biggest pieces of the puzzle. Interest rates matter because gold and silver do not pay interest. When Treasury yields rise sharply, the opportunity cost of holding metals increases. When yields fall, the opportunity cost decreases. That can make precious metals more attractive. The market has been focused heavily on inflation data because inflation directly affects what the Federal Reserve can do next. Recent U.S. inflation data was softer than some feared. July, consumer inflation came in at 3.4% year over year. That helped reduce expectations for another rate increase. The market response was visible across precious metals. Gold moved higher, silver moved higher, and investors began to think more seriously about what a less aggressive Federal Reserve could mean for precious metals. But there is another side to the story. Long-term Treasury yields remain elevated. That tells us investors are not completely convinced that inflation is under control. The United States also faces enormous fiscal challenges. Debt levels are high. Government financing needs are large, and investors are watching the bond market carefully. Recent reporting has highlighted concerns around long-term Treasury yields and fiscal deficits. The 30-year Treasury yield has reached levels not seen in decades. That matters because gold is not only an inflation trade, gold is also a confidence trade. When investors begin questioning currencies or government debt, they often look toward assets that do not depend on the promise of another institution. Gold has no issuer. A gold bar does not need a central bank to remain solvent. It does not require a government to make a payment. That is part of its appeal. And central banks understand this. Central bank gold buying has remained an important structural force. The World Gold Council reported that central banks added a net 41 tons of gold during May. That continues a broader trend of official sector demand. Recent reporting has gone even further. Reuters reported that second quarter central bank gold purchases reached 289 tons according to Deutsche Bank. That would represent an extremely powerful demand signal. Reuters also reported that 45% of surveyed central banks plan to increase gold holdings over the following year. That is not normal retail speculation. That is strategic reserve management, and that distinction is extremely important. A retail investor can sell tomorrow. A central bank can build a reserve position over many years. When official institutions steadily increase their gold holdings, they create a long-term source of demand. That does not guarantee higher prices every day, but it changes the underlying structure of the market. Now think about what happens if this trend continues while confidence in government debt becomes less certain. The investment case for gold becomes broader. It is no longer just about inflation. It becomes about diversification. It becomes about reserve management. It becomes about currency risk. It becomes about geopolitical risk. And it becomes about the possibility that the global financial system is gradually moving toward a different balance of reserve assets. That is where silver enters the story. Silver does not have the same central bank reserve role as gold, but silver has something gold does not have to the same degree. Industrial demand. Silver is used in electronics. It is used in solar technology. It is used in electrical applications. It is used in advanced manufacturing. And it remains important across several emerging technologies. That means silver can benefit from economic expansion at the same time that it benefits from monetary demand. This dual identity is what makes silver so interesting, but it is also what makes silver dangerous. Silver can move much faster than gold. It can rise rapidly. It can fall rapidly. And when investor positioning becomes crowded, the volatility can become extreme. This is why the current market should not be viewed as a guarantee of endless upside. A strong bull market can still experience brutal corrections. In fact, some of the strongest bull markets in history have experienced large declines along the way. That is especially important now because silver has already experienced enormous volatility. Recent data shows silver remains well below its 2026 record, near $115, even after recovering sharply from its lows. That tells us something important. Silver is not simply moving in a straight line toward one target. It is moving through a massive repricing process. The market is trying to determine what silver should be worth in a world where industrial demand is expanding while monetary uncertainty is also increasing. And that is the question investors should focus on. Not whether silver reaches one specific number, not whether gold reaches one specific number, but whether the underlying forces supporting the metals are getting stronger or weaker. So what would make this precious metals trend stronger? The first factor would be a continued decline in real interest rate expectations. If inflation stays elevated while nominal rates remain stable, then real yields can become less attractive. That can support gold. The second factor would be continued weakness in the US dollar. The dollar matters because gold and silver are priced in dollars. When the dollar weakens, metals can become cheaper for international buyers. That can increase global demand. Recent market data has shown the dollar losing ground over the past several months. That has helped create another tailwind for gold. The third factor is central bank buying. If official institutions continue adding gold, then the market has a persistent structural source of demand. The fourth factor is geopolitics. The world is not becoming less complicated. Conflicts remain active. Trade relationships are changing. Supply chains remain vulnerable. Governments are increasingly thinking about strategic resources, and precious metals tend to attract attention when uncertainty rises. But silver has another advantage. It is not only a fear trade, it is also an economic metal. That means silver can perform well when industrial activity is healthy. This is one reason silver can sometimes surprise investors. Gold can rise because investors are worried. Silver can rise because investors are worried and because manufacturers need more metal. That combination is powerful. Now there is another part of this story that deserves attention. Supply. Silver supply cannot instantly respond to a sudden increase in demand. A large portion of silver production comes as a byproduct of mining other metals. That means higher silver prices do not always produce an immediate surge in silver mine supply. A company may be mining copper or lead or zinc. Silver can come out of that same operation. The mine cannot simply double silver production overnight because the silver price moved higher. This creates a supply response problem. If demand grows faster than supply, then inventories can become increasingly important. And when inventories become tight, price volatility can increase. This is one reason silver can experience explosive moves after long periods of relatively boring trading. The market can remain quiet until suddenly it is not. That is the part investors often underestimate. They look at a chart and think the metal has already moved too much. But price alone does not tell you whether the underlying market has become tighter. You need to look at demand. You need to look at inventories. You need to look at mine supply. You need to look at industrial consumption. You need to look at investment flows, and you need to look at monetary conditions. When several of those indicators point in the same direction, the probability of a major trend increases. That is exactly why the current gold and silver setup deserves attention. It is not one single catalyst. It is a convergence. The Federal Reserve is dealing with inflation. The bond market is dealing with fiscal concerns. The dollar is facing changing expectations. Central banks are accumulating gold. Geopolitical tensions remain elevated. Silver demand has industrial support, and investors are increasingly looking for assets outside traditional financial structures. That is an unusual combination, and history shows that unusual combinations can produce unusual market behavior. But there is another lesson from history. Markets do not reward investors simply because the story sounds convincing. Timing matters. Valuation matters. Position size matters. Risk management matters. If silver becomes extremely overbought, then a correction can happen even if the long-term story remains bullish. If gold rises too quickly, then profit-taking can appear. If the Federal Reserve becomes more hawkish, then yields can rise. If the dollar suddenly strengthens, then metals can come under pressure. If geopolitical tensions ease, then safe haven demand can fade. These risks are real, and investors who ignore them are not investing, they are betting. The goal should be to understand both sides. So what should gold and silver holders watch from here? Watch the Federal Reserve. Watch Treasury yields. Watch the dollar. Watch inflation. Watch central bank buying. Watch silver industrial demand. Watch gold ETF flows. Watch physical premiums. And watch the gold-silver ratio. Those indicators can tell you whether the current move is strengthening or weakening. If gold holds its higher range while silver continues to outperform, then the message becomes increasingly important. It would suggest that investors are moving beyond traditional safe haven demand. They would be searching for leverage to the precious metals trend. That is where silver becomes extremely interesting. Silver has historically been capable of producing much larger percentage moves than gold during strong precious metal cycles, but the reverse is also true. Silver can fall much harder when momentum disappears. That is why the metal is often described as high beta gold. It tends to amplify the broader precious metals trend, and if this is the beginning of another major metal cycle, then silver could become one of the most watched commodities in the world, but do not make the mistake of thinking the next move has to happen tomorrow. Markets do not work that way. Sometimes the most powerful moves begin after months of uncertainty. Sometimes prices move sideways, while the underlying fundamentals quietly improve. Then the market reaches a point where investors suddenly recognize what has already been happening. That is when a breakout can become violent. The question is whether we are approaching such a moment now. There are reasons to believe the environment is becoming more favorable. There are also reasons to remain cautious. Gold has already demonstrated enormous strength. Silver has already demonstrated enormous volatility. The dollar has weakened. Inflation remains above the Federal Reserve target. Central banks continue to accumulate gold, and geopolitical uncertainty remains high. At the same time, long-term yields remain elevated. That creates a fascinating contradiction. Higher yields can pressure metals, but higher yields can also reveal concerns about inflation and government debt. If investors begin interpreting higher yields as a sign of fiscal stress rather than simply stronger economic growth, then gold can respond very differently. That is why the bond market may be one of the most important charts for precious metals investors right now. The real story is not simply whether yields rise. The real story is why they rise. If yields rise because the economy is booming and inflation is falling, then metals may struggle. If yields rise because investors demand more compensation for inflation and fiscal risk, then gold may remain strong. That distinction is critical, and it brings us back to the rare event mentioned in today's title. What is rare is seeing monetary uncertainty, geopolitical uncertainty, central bank accumulation, industrial demand, and changing investor positioning all appear at the same time. That does not happen every year. It can take decades for these forces to align, and when they do, the precious metals market can behave very differently from what most investors expect. The biggest mistake right now would be to focus only on the price. Instead, focus on the structure. Ask why gold is rising. Ask why silver is rising. Ask who is buying. Ask who is selling. Ask whether supply can respond. Ask whether central banks are changing their reserves. Ask whether the Federal Reserve is becoming more or less restrictive. Ask whether the dollar is strengthening or weakening, and ask whether the bond market is showing confidence or concern. Those questions are far more useful than simply asking whether gold will hit another record or whether silver will hit $100. Price targets are exciting, but market structure is what creates the opportunity, and if the structure continues to strengthen, then the next phase of the precious metals story could be much larger than the headlines suggest. We should also remember that gold and silver are not identical assets. Gold is primarily monetary. Silver is both monetary and industrial. Gold generally has lower volatility. Silver generally has higher volatility. Gold is heavily influenced by central banks. Silver is heavily influenced by industrial activity and investor demand. That means owning both can provide exposure to different parts of the same macroeconomic story. But it also means investors should understand the risks of each. There is no guaranteed asset. There is no guaranteed price. There is no guaranteed return. The market can surprise everyone. That is precisely why preparation matters. Right now, the evidence shows that precious metals remain highly relevant. Gold has shown remarkable resilience even as yields remain high. Silver has continued to attract attention despite massive volatility. Central banks remain important buyers of gold, and the global economic environment remains uncertain. Recent Reuters reporting described a renewed gold rush led by central banks while also highlighting geopolitical tensions and concerns around traditional reserve assets. That is the bigger picture. This is not simply a story about gold. It is not simply a story about silver. It is a story about confidence. Confidence in currencies, confidence in government debt, confidence in monetary policy, confidence in global trade, and confidence in the financial system. When confidence changes, the demand for hard assets can change quickly. That is why this moment deserves attention. Not because anyone knows exactly what happens next, nobody does, but because the forces underneath the market are changing. And history tells us that major changes in the monetary environment can create major opportunities and major risks. So if you own gold or silver, then do not just watch the price. Watch the signals. Watch the Federal Reserve. Watch the dollar. Watch Treasury yields. Watch inflation. Watch central bank demand. Watch silver supply. Watch industrial demand. And most importantly, watch the relationship between gold and silver. because that relationship may tell us whether silver is simply following gold or whether silver is preparing to take the lead. If silver begins consistently outperforming gold while physical demand remains strong, then the market could be entering a completely different phase. That does not mean silver will rise every day. It does not mean a straight line higher. It means the potential for larger moves becomes more important, and that is exactly why investors are paying attention now. The precious metals market is sending a message. The question is whether you are listening. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch for more gold and silver market updates. Tell me in the comments what you think is happening right now. Is gold entering another major phase? Is silver preparing for a much larger move? Or do you think this rally needs a major correction first? Your opinion could make the next discussion even more interesting. Stay informed, stay patient, and most importantly, stay focused on the facts. Because when the precious metals market makes a move that very few people expected, the biggest opportunities are often found by the investors who understood the structure before everyone else noticed the price.